DraftKings is one explosive growth stock with 15% upside according to Wall Street. Looking at Yahoo Finance analyst price targets, 28 analyst price targets, the average suggests that DraftKings stock should be valued at $24.36. DraftKings is currently trading at $21.25. Now, among these analysts from Wall Street, there is wide disparity in the valuation. One analyst thinks this stock should be worth $15, which is way below the 21, and one analyst thinks it should be worth $38, which is way above where it's at today. And you often have this among analysts on Wall Street with wide disparities in price targets because included in these price targets is a lot of assumptions and estimations, and changing these assumptions by a small margin will change the valuation by a wide margin, right? For one example, one of the inputs to these valuation models is called the weighted average cost of capital. And if you change this input lower, let's say you had it previously at 10.5% weighted average cost of capital, and you lower that to 8.5%. That relatively small decrease in the weighted average cost of capital will make a big change on the valuation of a stock. So you have those types of inputs where you make a small change and it makes a big difference in the valuation. So you might have one analyst that's using a weighted average cost of capital of 10.5%, and another one using 8.5%, another one using 9.5%, and those different assumptions or estimations in the financial models, financial valuation model, creates this disparity in what they think the price of the stock should be. So that's one side of the input. The other side of the input is the company's financial performance. So I wanted to look at some of those metrics and see what Wall Street is excited about and why they think there's 15% upside to this explosive growth stock. Well, one thing DraftKings has done exceptionally well is to grow its revenue. Looking at its trailing 12-month revenue going back just a few years, you could see it's exploded from less than 600 million all the way up to 2.2 billion in the trailing 12 months. Now, DraftKings started out as just a daily fantasy sports website, and it did really well in that regard. But in recent years, it's expanded into offering an online sports book and offering iGaming. So because of that, that's allowed new revenue, incremental revenue streams, but it's also loaded costs onto the company as it ramps up. It needs to get approval state by state. So in each state, it needs to uh, incur massive expenses rolling the service out. It's got to let people in the state know that, hey, it's legal now, we're available, come join us, right? So with each individual state, it runs a campaign like that, and it's costly, and that's been hurting the bottom line for the company. So 2.2 billion in revenue. Now, industry experts estimate that the mobile gaming market in the US at maturity will be $30 billion. That's the entire market. So DraftKings is not the only game in town. There's other competitors that are offering mobile sportsbook and iGaming, and estimates also suggest that DraftKings will take a one-third market share. So if it's 30 billion in revenue overall for the industry, DraftKings getting 10 billion in revenue, and DraftKings estimates on that 10 billion in revenue, they'll make between 2 and 3 billion dollars in profits. So this is at maturity. If everything goes according to plan, this is what they're hoping to do, is to bring in 2 to 3 billion dollars per year annually in profits on mobile gaming. Now this could be 5 years from now, 7 years from now. It's not gonna go perfectly every single step of the way. For instance, last year, DraftKings spent a lot of money, time, and energy trying to get sports betting, online sports betting, legalized in California, and they failed miserably. Oh my God, did they fail miserably? The vote in California was something like 20% in favor of legalizing sports betting and 80% against. So they spent a lot of money, time, and energy, and they failed. And there is no telling if they will ever get access to the massive California gaming market. So that's just one example, showing that it's not going to always go according to plan. They're not going to get access to every state when they think they are. So the stock right now has a market capitalization of 9.6 billion. That's the value of the business right now, 9.6 billion. And if you think about, if you say, okay, you know what, we grant you all these estimates, right? We grant you that the industry will reach 30 billion. We grant you that you'll get to 10 billion in revenue, and we grant you the fact that you're going to generate between 2 and 3 billion dollars in profits. The the stock at 9 the market cap of 9.6 billion looks cheap. Looks cheap if you think that all of those things are going to happen for DraftKings. The 30 billion in industry, 10 billion revenue for DraftKings, between 2 and 3 billion in profits for DraftKings. If all that happens, then a valuation of 9.6 billion looks cheap. And that might be what Wall Street is suggesting here, that hey, you know what, chances are these things are going to happen. And, right now DraftKings stock is undervalued if you think that all those things are going to happen. So I can see that case. I can see why Wall Street is, modeling out that this could happen. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And looking at the forward price to sales ratio of 2.62, it's rebounded off the lows. In January, it was trading at below 1.6, and now it's up to 2.62 in regard to the forward price to sales. So you could have got DraftKings stock a lot cheaper earlier in the year. Right now, I don't know, just looking at this metric, doesn't look like much of a bargain. It looks like it's trading at about the average valuation it has traded for in the last year and a half. Overall, this company is, an above average risk profile. I mentioned earlier all the things that need to go right for DraftKings to reach those estimates and assumptions that Wall Street might be using in its valuation. And then once it gets there, there is no guarantee that it's going to get these state licenses in perpetuity, right? It gets a license and then it's likely going to have to apply for renewal. And there is no guarantee that the state governments are going to grant that. So you have that higher level of risk because you're dealing with a gaming company. And, gaming is a sensitive depending on um, what state you're dealing with. You have some conservative states that are going to be really against allowing online sports betting. I don't expect DraftKings to ever get approved in the state of Utah. I just don't think that's a realistic assumption to make. And so, depending on the way the public leans towards their opinion against gambling or for gambling, you might have constituents, lobby their government and say, hey, don't allow this. Or you might have them say, yes, go ahead and allow it because it's bringing in tax revenue. That change of opinion, that's risky if DraftKings is going to rely on that. So I can see both sides of the picture here, and I can see why Wall Street thinks there's 15% upside. Again, if everything goes right, yeah, the stock looks undervalued, so I can see that case. All right, so that's all I've got for this video. Thank you so much for watching. I really appreciate your viewership, and I really hope I can see you again soon.